Bond yields spike after hawkish FOMC minutes and trigger a vicious rotation from growth to value stocks. Short options positioning exacerbates the moves as we see violent intraday swings in the VIX and the Vixen. And CPI and Treasury auctions this week will determine if the rates move continues. But with 4 hikes priced in for this year, the bar is set high. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is January the 11th, and let's take a look at these markets. So after beginning the year on a very positive note, markets turned aggressively lower. And that was because of obviously the hawkish FOMC minutes, signaling potential quantitative tightening way before anyone expected. And that led to one of the worst weeks in the US bond market in history, which is quite. Jim Bianco put out a tweet thread looking at the data, and it's quite crazy to see how bad it was last week relative to, looking back decades. So really, really shocking week for the bond market, with the US 10-year taking out the 2021 highs, hitting above 180, and more bear flattening in the yield curve. And then the March rate hikes now are, well, it's almost fully pricing in a rate hike in March, whereas before, liftoff for rates was more likely to be June. And now the probability of a March hike is almost as high as 70-80%, I believe. We've got the 10-year getting above that previous resistance that we saw early last year. 5 years exploding in a straight line up to about 150 as well. And just the carnage in the bond market, you can see the 5s, 10s, however, actually didn't steepen. So whereas the 2s, 10s steepened, the 5s, 30s, they actually flattened. So I'd been saying last week that I was going to fade any steepening that I saw in the 5s, 30s, because I thought it'd be quite short-lived. And, the first level was around 0.7 and then 76 and then 80. So I had a little nibble on it, put on some flatteners at around 70, 71. And before you know it, they're back below 60, even in the face of, quite hawkish, quite bearish action within the bond market. And then you can see here, what does the market expect for Fed? We've got one hike by March, 76% priced in. This was as of the 7th of January. So arguably it's gone a little bit higher than that. That's what I was saying, it might be 80, 85% now for March. But these are the kind of numbers we're looking at. But basically 4 hikes being priced in. It says it's a 50-50 in December 22 there. But again, I think that probability has moved as well. So I think 4 hikes being priced in since this data was out on the 7th of Jan is probably gone towards like 70%. So that's the kind of carnage we've been seeing in the bond market. So what has that done to equities? Well, that's led to a vicious rotation in equities. So if we bring up the sectors, it's been a move obviously out of growth and into value is what we typically see when we see yields spike like this. And so the growth sectors, obviously tech, but you're also seeing like the bond proxy type sectors, healthcare, more defensive sectors coming off. Real estate, and then what's rallying is the likes of energy, financials, metals and mining, right? So the cyclical, the value stuff, and very big divergence there where, the sectors that were getting beaten up were down 5-ish%, and the sectors that were up were anywhere between 5 and 10%. So, really big dispersion and vicious sector rotation. What else happened last week? Obviously we had non-farms. Whilst it was a headline miss on non-farms, the market kind of looked through the headline because that does normally get revised higher as well. And the data that the market is deeming more important on the jobs is the average hourly earnings, right? So are we seeing that wage inflation? So we saw a big print, biggest advance since April, we saw on average hourly earnings on the month-on-month change. And we saw the unemployment rate drop down to 3.9. which was more than was expected. I think it was expected at something like 4.1, came in at 3.9. So those were the signs that the market took, that was going to be more, that was going to allow the Fed to be more hawkish. It was in line with the rates move, basically, right? And then you can see the chart on the right is showing us the dot plot relative to the market pricing. So, the market pricing has been more aggressive than the dot plot for the front end recently. The market was pricing in 2-3 hikes next year, way before the Fed kind of capitulated and said, yeah, we got inflation wrong. We are going to have to hike sooner than we thought. But you look at it now, the market is still above. So the pink line is the market pricing as of yesterday for rates. And you can see anywhere out to kind of towards the end of 2023, the market is being more aggressive on hiking than the dot plot. But then anything after into 2024 and beyond, the dot plot's above the market. So the market's got a much flatter yield curve. And it's basically saying that we're going to have to hike more aggressively. But at the same time as doing that, that's going to not let us hike going forward, because growth's going to roll over. That's basically what the market is pricing. And the Fed, whilst they've capitulated on the bit in the front and raised their dot plot to the front, they are yet to drop their dot plot to the back. And I think it will take quite some time before they do that. And we don't know for sure. Maybe the market will catch up to them and we'll see some steepening at some point. But remains to be seen. And the bar seems to be quite high to see that sort of price action, given we've had the worst sell-off in the bond market in ages. And yet the curve, the 530s, was still flattening. All right, so it just goes to show how strong that dynamic is at the moment. Yeah. All right, so that's what we're seeing on the jobs front, and how the yield curve reacted to it. Now, if we think about what is the obviously market that's being most impacted by yield, we obviously said growth stocks, but the Nasdaq, if we look at the broader indices, obviously the Nasdaq's the one that's taking the biggest beating. We see Nasdaq chart. Obviously, didn't quite get down to the 200-day, but, got pretty, had a go. Intraday, it was down best part of 3%, and then finished green on the day, which is quite spectacular yesterday. But, tech's just been getting trashed. This Vixen versus VIX ratio is quite interesting. So that's the ratio between the vol on the Nasdaq and the vol on the S&P. So the Vixen versus VIX. And that's obviously spiked as the vol on the Nasdaq rallied, but that seems to have reversed a bit intraday, right? So when we've previously seen spikes and turns around in that type of ratio, that signaled a bit of a bottom in the Nasdaq. If we look back, particularly to this one sort of in Q1 last year, maybe there's some signs of life there that we might have kind of hit peak panic in tech, and we stage some kind of bounce there, basically, right? That's what that vol signal might suggest, right? Another encouraging sign from the vol markets is that, well, if it's the rates volatility, and rates going higher isn't necessarily a killer for equity markets, right? It's more about the velocity and the pace at which rates go higher. So if we're seeing interest rate vol move down from the move index moving a bit lower, that's suggesting that rates market, now that we've had this yield spike, is thinking that we're going to stabilize at higher yield levels. That might actually be good. So even though we're seeing a spike in equity vol, which was lagging rates vol, as rate vol's coming down, that will probably be good for equities, right? If rates vol really can come down a bit, that stabilization of yields at the higher level, the market can digest that and can probably rally from there, right? And that's similar to what we saw early last year, right? Initially on the rate spike early in the year, markets didn't like it, but once rates stabilized, they were okay with it. And obviously then rates came quite a bit lower, but even if rates had stabilized at the higher level, signifying, better growth, markets probably would have digested that well. And if we back test that and look back at previous years, rates going higher isn't a killer for equities in general, basically. Yeah, it's just the speed at which it does it. Okay, and then if we look at, just simple sort of RSI metrics, obviously NASDAQ got pretty oversold. RSI got down to like 23, 24. And if you look at the 10-year, that RSI got pretty high, right? 84, kind of as high as it really gets. Yeah, so things definitely looked overstretched, and the market responded intraday to those levels and reversed quite dramatically. Another thing that would make you a little bit more bullish would be the positioning, right, and sentiment. So sentiment, obviously there was de-risking that went on before year end. That's very normal. But, you know, you look at long short, and this is from JP Morgan Prime Brokerage, you look at kind of gross and net leverage for hedge funds, that's, you know, fairly low, right? If you look back the last year, that is kind of looking at 1 year lows. You look at the sentiment indicator from Goldman's that they put out, that's looking like between light and extremely light positioning. So the market isn't really positioned for a bounce here, which kind of makes it more likely, basically, right? So something to be aware of there. We got to very oversold levels. Positioning's pretty light. You know, those are the type of things you want to see to give you, you know, potential green lights that we may have a bounce on. And we've already had a dramatic bounce off the lows. We had that intraday 3% bounce, but, you know, could it persist a bit longer? These sort of indicators suggest it might. If we look at the options positioning now, you can see that obviously we were well into short gamma territory, right? So once we broke below that 4,700 area last week, we had S&P go into negative gamma, NASDAQ into negative gamma, which it already was, I believe. So heavily into negative gamma, right? So down here near the put wall is where we got to on S&P, firmly in negative gamma zone. NASDAQ got down to like 370, again, pretty much at a max amount of short gamma down there. And that's why we chop around so dramatically intraday, basically, right? When the street just doesn't have that stability because market makers are having to chase the moves whichever way they go. Okay. Spot Gamma also put out this kind of chart showing on the S&P that there was a bit of a dramatic sort of change in positioning around this 45.80 area, which is why they've flagged that as one potential level. And that turned out to be the exact level we bounced off, right? So we bounced off, I think, 45.81, and they had 45.80 there written down clearly in their report as a level. So that worked pretty well, right? If you're leaning on those levels, right, to guide you. And then the hero indicator is one that you know they've also got, which is pretty interesting to use intraday. Shows you what the options flow looks like intraday, what people are doing in calls and puts, and whether they're incrementally buying or selling delta. And so basically, the blue line is showing you that from about noon, you know, once any puts had finished being bought, delta was going positive via puts, which means people were selling puts, and that kind of continued throughout the day. And then you also had calls going positive, so that's some call buying, basically, right? So you saw call buying and put selling from about noon onwards to kind of help reinforce the rally that we were seeing. Maybe it was partly what was driving the rally. Obviously, the VIX collapsed pretty dramatically as well from its intraday high, which would have helped fuel some of that Vanna delta hedging that happens when vol compresses and dealers have to buy back futures. If we bring up DXY, I mean, it's just stuck in a crazy tight range from like 97 to 95.5, right? It's a pretty tight range. Consolidating, that technically that suggests this thing's going higher at some point, right? So for now, despite the hawkishness that's coming out of the US yield curve, you would have expected dollar to break higher. It hasn't. That suggests that people maybe are expecting the ECB to be, you know, equally hawkish. And, you know, given their bond yields are at zero, like bond yields are at zero, they've got lots of room to rally. Personally, I think growth is going to be less robust in the EU. And I think the dollar will break higher at some point. And if you look at like what it's done against the yen, well, it is breaking out nicely there. It is definitely going higher versus the yen. So I think at some point the dollar is going to go higher versus the euro as well. It's just a matter of time. Now, if we look at yields, probably the interesting thing on yields, like I said, is going to be these auctions. And I'd expect foreign buyers to show up, right? Like we mentioned, a lot of what goes on in the long end treasury market is dependent on what the foreign buyers do. And, you know, you look at the recent move in yields and what that looks like to euro hedged US treasuries. If you look at what the yield is, around 96 basis points, that's the highest it's been in 5 years, right? So for European fixed income funds, that's an attractive proposition. Yeah. So I think that's going to be supportive potentially to the long end and kind of help with this general flattening dynamic. So whereas, you know, you've had the whole curve shift quite a bit higher, you might get the auctions actually go quite well bid and the long end kind of bounce a little bit, bouncing bonds and yields come back down, whereas the front end just kind of stays up there because the front end's reflecting rate hike expectations, right, which are going to kind of stay there for a while until we see inflation really start to roll over in the data, which is not likely anytime soon by the looks of it. Yeah. So that's kind of what we're looking at in rates and bonds, sorry, in FX and bonds. If we then move over to commodities, I mean, you got oil, obviously, is quite interesting. Very solid price action on oil, you know, in the recent bout of risk off. And that's because it wasn't just a broad-based risk off, right? Cyclicals rallied, right? So the idea is the reason rates are going higher or need to go higher is because the economy is quite strong, right? That's the narrative anyway. So you wouldn't expect oil to roll over dramatically on that narrative, right? So oil held, it had the retracement it needed to get over that we had flagged last week was this 77 area. It popped up to around 80 and a bit. It's kind of held. It hasn't got back below 77. So whilst oil stays above 77, no reason to think this thing isn't going back to the highs and beyond, right? The likes of Eric Townsend in Macro Voices, obviously he's into his crude. He's more knowledgeable about that space and has traded it for longer. He thinks oil's going to 100, right? So at some point, right? He's not saying it's going there tomorrow, but you know, a lot of guys who look at oil, the likes of Tony Greer, Eric Townsend, these guys who definitely have been in the oil market for a long time, that they all see this thing going a lot higher. Yeah. So I'm holding oil. I am long oil. I'm also long carbon. I'm also long uranium. I've got a nice little energy basket going on there. It's quite a high vol, but you know, it's a theme that I like. I can see all of those things trading higher over the course of the year. So I'm planning to hold some exposure to that three-way basket in some shape or form, and just maybe kind of push towards the stuff that's working, but hold some exposure to those three throughout the year, right? That kind of energy commodity exposure, I think, is a theme that you want to hang on to this year, basically. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.